Like many of you, I just finished watching ESPN's The Last Dance. Now, mind you, I'm a native of Chicago, so I was already biased to begin with. But Michael Jordan and the 1990s Bulls, they didn't give you one reason to go down in history as one of the greatest NBA franchises with their victory in 1991. They didn't give you two with their victory in 92. They didn't even give you three with their three-peat consecutive 3 wins in 93. They came right back at you in 96, 97, and 98 for a second three-peat and for a total of six championship wins in the 1990s. Just like they stunned, just like they gave you 6 compelling reasons to go down in history as one of the greatest NBA franchises, today I'm going to share with you 6 reasons why multifamily real estate is arguably one of the greatest asset classes and investment vehicles to achieve financial freedom. Stay tuned for more. The first reason is that multifamily real estate is simple to understand and to implement. Whenever you're investing your hard-earned money, it is important that you understand the fundamental business that you're investing in. And it doesn't get any simpler than multifamily real estate. As long as human beings occupy this planet, they will need a place to call home, a shelter, housing. As a multifamily real estate investor and apartment building owner, you will be providing this essential and basic need. In exchange for doing so, your tenants will pay you rent. As long as that rent outpaces the expense to operate and own that apartment building, you will be making a profit or a positive cash flow. Multifamily real estate also provides its investors with supreme asset control, meaning that you have the ultimate decision-making capabilities as it relates to not only the location or market that you invest in, but the size of the buildings that you invest in. Whether those buildings have studio apartments, 1-bedroom, 2-bedroom, 3-bedroom, or beyond. Beyond that, you also have the ability to select your tenant pool or your client base. And through a lease, a legal document that manages the relationship between you and your tenants, you have further ability to control and dictate how that relationship plays out. Generally speaking, with any asset, the more control you have, the more predictable the performance and profitability of that asset. When investing in stocks, you don't have this control. You can do your due diligence and research on the front end, but you don't have any control over what the board of directors or the CEO and management team do in managing debt, leveraging free cash flow, what decisions they make on a daily basis. But in multifamily real estate, most, if not all of these decisions are yours to make. Leverage has got to be one of the most compelling reasons why multifamily real estate is an excellent investment vehicle for not only the pursuit, but the accelerated arrival at financial freedom. So what is leverage? Leverage is when you utilize other people's money in the form of a loan from a bank or another lending agency in partnership with your own cash to own and control an asset that's worth far more than the cash invested. This is a very important principle to understand. So let's take, for example, the stock market. To own and control $200,000 worth of stock, you would actually need $200,000 in cash. Alternatively, to own an asset, a multifamily real estate building valued at $200,000, you would only need 25% of your own capital invested or less. For this example, we'll say 20%. 20% of $200,000 is only $40,000. So to control an asset that's valued at $200,000, you would only need $40,000 in cash invested. Now let's further assume that you actually had $200,000 to invest. If you had that $200,000, assuming our 20% down principle, you would effectively be able to control $1 million worth of real estate, whereas that same $200,000 would only control $200,000 in stocks. Let's go back to our original example, where you've got $200,000 or 100% invested in the stock market for $200,000 worth of stock. And you've got $40,000 invested for an asset in multifamily real estate that's valued at $200,000. Now, assuming you got a 10% return on your $200,000 invested in the stock market, that would be $20,000. If you applied that same return to your multifamily real estate investment, where you only had $40,000 down or invested, you would effectively have a 50% return on investment compared to your 10% return on investment in the stock market. So leverage allows you to stretch your dollars to own an asset of far greater value, and it also increases your rate of return or your return on investment from capital invested in that asset. Let's talk about the money, because that is arguably the primary motivator for why you're considering investing in multifamily real estate. Multifamily real estate has four potential income generators through its long-term ownership and operation. The first and most important is cash flow. Cash flow is simply the idea that the income generated by a multifamily building exceeds the expenses to own and operate it. If you saw my video on how to transform your dreams into reality, then you know that my personal business model requires that for any building that I consider purchasing, that each unit generate $200 per month in after-expense cash flow, in addition to the building generating 16% minimum cash-on-cash return. The second income generator is appreciation. Appreciation is simply the idea that the underlying asset value will increase over time from the price that you paid for it. So if you purchase a building for $200,000 and in 15 years that building is now worth $300,000, then you've seen $100,000 appreciation in the underlying asset value. Now, whether you decide to sell and capture that $100,000 gain, or you can re-leverage the property and pull out capital now that the building is worth more. The third income generator is what we call debt paydown. When you originally purchased this property, you used leverage or other people's money in the form of a loan, where you only were required to put down 20%. The other 80% of that asset value was financed through a bank loan. Guess who pays that loan? Your tenants pay that loan. So, over a period of time, if that loan is amortized over 20, 25, or 30 years, you will see a decrease in the amount of principal balance that you owe the bank for borrowing that money. Your tenants are paying that down. As they pay that down, your equity position in that piece of property is increasing over time. After that loan has been paid off, that equity position is now fully yours to capitalize and gain through the sale or through the refinancing of that property in a cash out refi. The fourth and final income generator are tax advantages. These are specific provisions set up by the Internal Revenue Service that allow long-term multifamily real estate owners to write off certain expenses against their income. This effectively allows multifamily real estate owners to pay less in taxes, keeping more money in their pocket. What are these expenses? One of these expenses are capital improvements. When a multifamily real estate owner decides that he needs to add a new roof, new windows, a new boiler, or furnace to his or her property, that expense can be written off dollar for dollar against the income generated by that property. Depreciation is another consideration. Depreciation is simply the idea that any man-made structure has a useful life. When you purchase a property, typically 80% of the purchase price is housed within the improvement on the piece of land. The other 20% is the land that the improvement sits on. Now, land doesn't depreciate, but the structure that sits on the land can depreciate. And what that means is that the IRS will allow you typically for a 4-unit building or less, over a 27.5-year period to write off in equal increments the value of that improved structure. This also reduces your taxable income. In addition, once you incorporate as a multifamily real estate owner in an LLC or an S Corp, any expenses that you have to operate that building, travel to and from, home office, and any other associated expenses can be written off against your income. These are the 4 income generators that lend themselves to multifamily real estate being a supreme asset class. Let's review. Cash flow, appreciation, debt paydown, and tax advantages. Another point of consideration is that multifamily real estate is a tangible asset, which means that it can be seen and touched, which therefore means that it can also be updated and improved upon to increase its profitability. By increasing a building's overall energy efficiency, a landlord is able to reduce his or her operating expenses and keep more money in their pocket. In the city of Chicago specifically, a lot of older buildings are on radiant heating systems with a single gas meter, which means the landlord is responsible for that expense. A lot of savvy landlords are upgrading those heating systems and getting individual meters for each apartment and putting furnaces in those units, and by doing so, they're transferring the expense of heating those units to their tenants. This allows them to not only charge more in rent, but to reduce their operating expenses. A landlord or multifamily property investor can also upgrade the internal cosmetic condition of their apartment units. By doing so, they will typically increase the quality of tenants that they attract. They will ensure that those tenants typically stay longer than they otherwise would, and they can charge more for those apartment units in rent. You cannot upgrade a stock once you buy it. Once you buy a stock, you're sitting and holding it, hoping that the management team or the CEO and board of directors are going to make savvy and intelligent financial decisions to increase the quality of that corporation and to increase the value of its stock. Multifamily real estate is a people-oriented business, and the more you become known in a specific market as a multifamily real estate investor, the more ingrained in that community you become, and the greater opportunity you'll have to build significant relationships with the key players in those communities. The real estate brokers, the real estate lenders, other real estate investors, and the key community stakeholders. When you develop these relationships, you will have an opportunity to expand your business and have access to off-market deals at better prices than you otherwise would have. These relationships will help to foster the growth of your business and the expansion of your property holdings. You cannot network your way into more stock ownership, but you can network your way into becoming a significant multifamily real estate owner in a specific market by first starting with one building and then building upon that and building relationships with other players in that market. Thank you for tuning in to this episode of Employ Your Money and the 6 reasons that I believe multifamily real estate is an optimal investment vehicle to assist anyone in pursuit of financial freedom. I hope you enjoyed this material, you found it informative and entertaining. Please smash the like button, share, subscribe to my channel. I'm hoping that this will be a vehicle to help inspire other people to either continue or to begin